Hello, students. Okay, in today's lecture, we are going to keep discussing about the debt financing. More specifically, in this video, I will cover topics like different kinds of private debt and the issuing procedures for public bond. And then we are going to discuss and learn many different terms of debt contracting. Okay, so let me share the PowerPoint slide here. Let me go to the slideshow. Okay, recall from the last lecture that we have discussed that just like in equity issuance, in private, in debt raising as well, debt can be both raised privately and publicly. And there are many different kinds of private debt as well. The most popular and prevailing kind of private debt is, not surprisingly, the bank loans. Even within the bank loans, there are many different kinds as well. The most popular and prevailing kind of bank loan is what is called term loan. It is a bank loan that lasts for a specific term, like 5 years, 10 years, or even 30 years. Okay, that is the plain vanilla bank loan that you can think of. So when the term loan begins, a bank will provide a cash to the company, and over the maturity or the term of a loan, the company will pay back periodic interest back to the bank, and at the maturity, the company will also pay back the principal amount back to the bank. Second category of the bank loan is what is called syndicated bank loan. It is a single loan that is funded by a group of multiple banks rather than a single bank. Recall from chapter 14 when we discussed the IPO deals, we discussed that in an IPO market, a syndicated deal is, the popularity of syndicated deals is growing because the amount of capital sought by the company is increasing, and we are seeing many mega deals where the amount of capital sought by a company is exceeding any one investment banking firm's risk appetite or capacity. Same trend is happening in the debt financing market as well. So a lot of firms are trying to acquire a mega loan where the amount of capital sought for is beyond one bank's capacity. So growing in a debt market as well, a growing trend is syndicated bank loan deals where multiple banks come together to fund one company's capital raising. Third kind of bank loan is what is called revolving line of credit, or revolver in short. It's a credit commitment for a specific time period up to some limit, typically 2 to 3 years, which a company can use as needed. So for this revolver, you can just think of it as a credit card for the company. Okay, so just remember how your credit card works. So for a specific period of time, normally a month, you have a credit limit, and within that credit limit, you can withdraw the amount and use the credit. And when once the period is over, you pay back the amount as much as you have withdrawn, and then the period is reset and your credit limit is reset. The revolver works exactly the same fashion as your credit card. The fourth category of bank loan is what is called asset-backed line of credit. It is a type of credit commitment in which the borrower secures a line of credit by pledging an asset as collateral. Are you guys familiar with the concept or terminology collateral? Yes, it is a kind of asset, specific valuable asset that can be used in the event of default to support the payment back to the debt holders. You know, by the definition of the default, in the event of default, the company doesn't have enough operating generated cash to meet the obligations to debt holders, in which case the collateral valuable assets can be liquidated, and the proceeds from the liquidation of those assets can be used to pay back the holders of the asset-backed line of credit. Well, although bank loans are the most prevailing and popular kind of private debt, it's not the entire picture. some bonds can be issued private as well, okay? So which is called private placement, okay? So private placements at a glance, they resemble pretty much a public bond, but they can be raised privately. So private placements are a bond that does not trade on the public market, but rather is sold to a small group of investors. The most important regulation related to the private placement is what is called Rule 144A, okay? So Rule 144A was issued by the SEC in 1990 for the purpose of increasing the liquidity of a certain privately placed debt. Remember when we discussed the pros and cons of raising debt privately as opposed to publicly, one of the most important limitations of the private debt was the illiquidity. So when the debt is raised privately, there's no public market to trade the securities. Therefore, the liquidity and trading becomes a problem. And Rule 144A was issued to overcome this illiquidity problem. So when private debt is issued under this Rule 144A, these bonds can be traded by large financial institutions among themselves. Still, individual investors like you and I cannot be participating in the trades, but large institutions, financial institutions like banks and mutual funds, they can trade the bonds issued under the Rule 144A. This makes the placements, private placements issued under Rule 144A only slightly less liquid than the public bond because in the public debt market, unlike equity market, anyway, the main players are large institutions as well. So the ability to trade a bond among large institutions greatly help overcome the illiquidity problem of the privately placed bonds, okay? So many firms issue private debt under this Rule 144A to combine the benefits of private debt issuance and public debt issuance. So normally companies issue private debt with a specific promise that they will convert these bonds to a public bond within a certain frame time. Okay, so in this fashion, companies can raise capital very quickly. The capital they much need, and then they can take time to comply with all of the filing requirements, and then eventually convert the bonds to public so that they can overcome the illiquidity problem. So now let's talk about the public debt issuance procedures. Public debt normally takes the form of public bond, and the procedures to issue public bond is very similar to issuing public equity. So most procedures are similar to the procedures that we have learned in Chapter 14 when we discussed the IPO. Just like in an equity offering, public equity offering, when the company wants to offer public bond, a prospectus has to be produced. In the context of the debt offering, a prospectus is also called offering memorandum. A prospectus, bond prospectus, or an offering memorandum works similarly as the equity prospectus. So it describes the details of the offering, okay, and it is containing information about the structure of the deal and the background of about the company, etc. One major difference between the bond prospectus from the equity prospectus is the presence of an indenture. Okay, so the bond prospectus must include an indenture, which is a formal legal contract between the bond issuing company and a trust company. And this indenture specifies the firm's obligations to the bondholders. Okay, and it is a legal contract written between bond issuing company and a trust company, which represent the bondholders' interest and make sure that the terms of the indentures are enforced. Now, let's discuss many different terms of debt contracting. We are going to focus on the public bond contracting case, but a lot of terms are shared for both private debt and public debt. First of all, let's discuss basic terms. Number one term is what is called coupon payment. Coupon payment is fixed amount of interest that the bondholders receive periodically. Okay, normally in the U.S., most public bonds pay coupons semi-annually. In other words, every 6 months. Maturity is the length of the bond life or the length of the contract. Maturity takes a wide range, but it's normally less than 30 years. So there can be 10-year bond or 20-year bond or 30-year bond, many different kinds, but normally the length is less than 30 years. Face value is standard denomination, normally $1,000 in the US. Face value is used together with the coupon rate to compute the periodic coupon amount. So suppose a bond is issued with a coupon rate of 10% and semi-annual coupon payment and face value $1,000. Then periodic coupon payment amount is 10% times 1,000, which is face value, divided by the number of payments per year, which is 2 in the case of semi-annual coupon payment. So therefore, in this case, periodic coupon payment amount will be $50 every 6 months. Okay. Well, issue price is the price at which the public bond is priced initially. So it's just like similar to the offer price in the IPO. Okay. When the issue price of a bond is equal to the face value, we call that the bond is issued at par. So when the bond price is initially priced at $1,000, we call that the bond is issued at par. Okay. When the issue price is less than $1,000, the face value, we call that the bond is issued at discount. As opposed to that, when the issue price of a bond is above $1,000, the face value, we call that the bond is at premium. Let's take a deeper look into the relationship between the yield to maturity, coupon rate, and the issue price of the bond, and also trading price of the bond. So a lot of students are confused between the yield to maturity and coupon rate, but these two rates are totally different two rates. Okay, so first of all, YTM or yield to maturity. It represents the market conditions, and it is what investors think they deserve. Therefore, YTM can change over the life of a bond depending on the market condition changes. As opposed to that, coupon rate is a contractor term. And this is what the borrower, the company, is offering to investors. Therefore, it is fixed and do not change over the life of a bond. And depending on the relative relationship between the YTM and coupon rate, the bond price is set in changing. First of all, when the YTM equals coupon, what does that mean? It means that what investors think they deserve is equal to what is offered by the company. Therefore, in this case, the bond will be issued and selling at par, $1,000 face value, okay? Well, if the YTM is lower than coupon, what does that mean? It means that what investors think they deserve is lower than what the firm is offering. Such bonds will be very popular because the firm is offering more than what investors require. So those bonds will be issued or sold at premium above $1,000. On the other hand, if YTM is larger than coupon, what does it mean? It means what investors think they deserve is larger than what the firm is offering. So those bonds will not be very popular, okay? So to make investor to buy those bonds have to be sold at a discount price. So the bonds will be issued and sold at discount, which is below $1,000. The relationship between the YTM coupon rate and the bond price will be very important. I'm not going to ask you to compute the bond price specifically, but I will ask you whether the bond is priced at par or at premium or at discount, given information on the YTM and coupon rate, okay? Now, let's talk about one of the most important debt contracting terms, which is the security. Okay, depending on the presence of security, we can divide the debt contracting into two categories. One is unsecured debt, the other is secured debt. Okay, the secured debt is a type of corporate loan or debt security in which specific assets are pledged as collateral. So the holders of secured debt, they have one more layer of protection in the event of default. So when the default happens, therefore, there is no enough cash to pay back all debt holders. The collaterals, normally most valuable assets within the company, can be liquidated, and the proceeds raised from the sales of assets should be solely used to support the payment back to these secured debt holders. Okay? As opposed to that, unsecured debt holders don't have such collaterals. Okay? So unsecured debt is a type of corporate debt that in the event of a bankruptcy or default, gives debt holders a claim to only the assets of the firm that are not already pledged as collateral on other debt. Okay, so for the unsecured debt holders, they can only have claims on the general assets that are not pledged as collateral. So by definition, secured debt holders, they have a better protection of their claims in the event of default and bankruptcy. We can more finely divide the unsecured debt and secured debt. Within the unsecured debt category, we have notes and debentures. And under the secured debt category, we have mortgage bonds and asset-backed bonds. Let's take each category in more detail. First of all, within the secured debt category, we have a mortgage bonds and asset-backed bonds. This classification is based on the kind of assets used as collateral. So if the collateral is some form of real estate property, we call that mortgage bonds. For asset-backed bonds, the kind of assets that can be used as collateral can be taken any form. For example, for airliners, it could be aircrafts, or for the rental car companies, the collaterals can be cars. Under the unsecured debt category, we have notes and debentures. And here, the classification is depending on the length of the bond life. Okay, and the cutoff is a 10-year. Okay, so if for unsecured debt holder, unsecured debt with less than 10-year maturity, we call that notes. And unsecured debt with longer than 10-year maturity, we call them debentures. The second most important debt contracting terminologies is the seniority. Okay, so seniority is a bondholder's priority in the event of default in claiming assets not already securing other debt. Okay, so by the definition of default or bankruptcy, when bankruptcy happens, default happens, there is no enough cash or assets to make every debt holder satisfied. So the U.S. bankruptcy law specifies that debt holders have to receive their money in a set order. And the seniority is defining the order of receiving their money. Okay, so if you are more senior debt holder, you will receive your money first. And if you're junior or subordinate debt holder, you will have to wait until more senior guys are fully satisfied. Okay, so if you are a subordinate debt holder, you have a lower priority in claiming the assets of the company. Okay, well, but remember, even if you are the most junior debt holder or most subordinate debt holder, still you have prior to the equity investors. Okay, so in the event of default, equity investors have almost no right in the company. Just to give you a better idea about how the seniority and security works, let me show you this example. Sorry. Let me open up this example. Hold on, sorry. Okay, So let's take a look at the effect of seniority and security on the recovery rate in the event of default. So suppose a firm is in default and the company sold off all of its valuable assets and the total proceeds raised from these asset sales were 150 million, okay? And right now, the firm had three kinds of debt claims outstanding. Number one is secured debt. Second is senior unsecured debt. Third is junior unsecured debt. And let's suppose the original claim amount for each category was $100 million, okay? And the seniority and security will define in what order the payment should be made, okay? So secured debt holders, they will receive their money first, okay? And remember that the total amount of assets or cash proceeds that we have in hand is 150 million. And secured debt holders will receive their money first. Their claim is 100 million and the company has more than enough to make them fully satisfied. Therefore, the secured debt holders will receive total 100 million. Therefore, even in the event of default, the secured debt holders' recovery rate will be 100%. Now, the 100 million was used up to pay back secured debt holders. And now we have only $50 million left within the company. And who's the next in line? Senior unsecured debt holders, they are second in line. And their original claim is $100 million. But the company only has $50 million left. So the recovery amount of the senior unsecured debt holders will be $50 million. In other words, 50% of their original claim. Now, everything has been used up to pay back more senior guys. The next in line is junior unsecured debt holders and their original claim amount is $100, but nothing's left within the company. So the recovery amount for the junior unsecured debt holders will be $0 million in this case. In other words, zero recovery rate. So as you can see, even in the same default event of one single company, depending on the seniority and security of your debt claim, your recovery rate could be greatly different. Okay, so that's why seniority and security is very most important debt contracting terms. Okay, and let's go back to the PowerPoint slide. And this chart shows you the average recovery rates on defaulted debt by its seniority. Okay, not surprisingly, as the seniority and security decreases, the recovery rate decreases as well. The bank debt, which normally is secured and having super seniority, they on average recover more than 80% of their original claim, even in the event of default. And then next is the senior secured debt holders. They on average recover about 67% of their original claim. And then recovery rate keeps decreasing as the seniority and security drops, not surprisingly. Okay, so once again, combination of the seniority and security will define your experience in the event of default. Therefore, these two are the most important terms in the debt contracting.